Hello everyone and welcome to today's video where we will be discussing Ind AS 41 on agriculture along with the important and the tricky questions of this topic. So this is Ind AS 41 which is on agriculture, a fairly specialized standard which was not there in AS. Now what is the coverage and what is excluded over here? So as per Ind AS 41 it includes three specific items. First is biological, that is living assets other than bearer plants which are used for agricultural purposes. So there are three things over here that you need to know. First is biological, that means they are living assets or living plants other than bearer plants, because bearer plants get covered under Ind AS 16, which are used for agricultural purposes. So if they are not used for agricultural activities, then they are not a part of Ind AS 41 and they will go to other standards like Ind AS 16 and we'll do problems on that as well. Second is agricultural produce, that is, let us say in case of a cow, milk; in case of a sheep, wool; in case of let us say a fruit plantation or a tree, let us say like apple trees, apple is the agricultural produce at the point of harvest. And thirdly, government grants which are linked to biological assets which are measured at fair value less cost of sale. Now these are the three specific things which are covered under the standard. So why are these covered under the standard? We'll take that into consideration, but what is not covered is bearer plants because they go under Ind AS 16. Agricultural produce after harvest. Remember, only at the point of harvest will Ind AS 41 apply. Before harvest, like harvest is like detachment, for example, of the fruit from the tree. Before harvest, the fruit is already a part of the tree, so it will be a part of the biological asset. After harvest, it becomes inventory, but at the point of harvest, it is covered under Ind AS 41 and we will discuss why. And lastly, government grants which are linked to bearer plants. So government grants which are linked to bearer plants will go under Ind AS 20 because bearer plants are not covered by the standard. Apart from that, clarificatory exclusions like agricultural land or assets used for agricultural activities which are not biological, like for example tractors, are not covered by the standard. They will go under the respective Ind AS 16. Or even licenses for agricultural activities will go in the respective standard, that is for example Ind AS 38. So what is agricultural activity? So biological asset other than bearer plants used for agricultural activity. Now what is agricultural activity? Now that it has two layers for your understanding. First is agricultural activity involves biological assets which are held for sale. Now typically, usually agricultural activity we associate with things like farming, etc. The standard does not define it like that. It says if biological assets are held for sale or for converting into agricultural produce or for converting into additional biological asset, it is treated as agricultural activity. So for example, if your biological asset is something like a poultry farm and you're holding it for sale, then these birds in a poultry farm will be taken as a biological asset for agricultural activity. Secondly, for converting into agricultural produce, like for example, if you're holding a tree where you are going to get, let us say, fruits. Now the tree per se may be a bearer plant. However, if you are holding it for the purpose of, let us say, the fruits, you are having an agricultural activity. It may, or the tree may not be covered under Ind AS 41, it may be Ind AS 16. The fruit at the point of harvest may be covered under Ind AS 41 if specific things are fulfilled, but you are holding them for converting into agricultural produce. Like for example, if you are holding, if you are a mule and you are having cows, you are not holding the cows for the purpose of sale. However, you are holding them for the purpose of converting into agricultural produce, let us say milk. So that is also agricultural activity, or for converting into additional biological assets. So you have, let us say, hens which you are holding so that you can make eggs, or you are having fish where you can breed, and on breeding, for example, you can have new fish. So all of these can be treated as a larger part of the agricultural activity. Now, merely because you are performing this activity, does that mean you will be covered under Ind AS 41? No, the third layer. So layer number one is there should be living assets, that is biological assets other than bearer plant. Layer number two is it should be agricultural activity which involves biological assets for sale or for the purpose of converting into additional biological assets or for converting into agricultural produce. And lastly, you should be managing the biological transformation which involves, let us say, managing the growth, reproduction, degeneration, etc. of these biological assets. So if you are managing this biological transformation apart from harvest, so harvest over here can be something like detachment of the produce, like plucking of the flower or the fruit, or it can mean like something that you are selling, or seizing the life processes like slaughter can be harvest. So basically, if you want to detect whether you are covered under this standard or not, then you'll have to see three things. First, are you a biological asset other than bearer plant? Second, are you performing an agricultural activity which can involve either of holding the biological assets for sale, or for converting into additional biological assets, or for the purpose of agricultural produce? And lastly, you should be managing biological transformation. If all the three are met, then for this particular item you can apply Ind AS 41. So if we take examples like ocean fishing, so if you do ocean fishing, over here you're not managing any biological transformation, you're just harvesting the fish, and you may be holding it for sale or agriculture produce or whatever it is, but you're not managing the biological transformation. Ind AS 41 does not apply. Or if you look at items like zoos, for example, in case of a zoo, you are managing the biological transformation, you are managing these animals. These are living animals, so biological assets, not bearer plants. However, there is no agricultural activity, so you are holding them for the purpose of recreation of the visitors, not for the purpose of sale, not for converting to agriculture produce or another biological assets. Same is the case with security dogs, which are not covered by Ind AS 41. So if not 41, where will they get covered? Well, probably Ind AS 16, because Ind AS 16 excludes biological assets which are held for agricultural purposes. It does not exclude every biological asset. So if the biological asset is not covered under Ind AS 41, it can go back to Ind AS 16. So there's a sum also on this which we will be discussing today. The more important part is not identification. In my opinion, it is the accounting. So when we go to biological assets, how will you account? Well, initial recognition of a biological asset happens at fair value less cost to sell. Now this is very special because typically everywhere else the initial recognition happens at cost. However, for a biological asset, a very special feature is something like reproduction, and hence these biological assets may possibly reproduce, and if they do, and they will generally, then for the new biological assets the cost is zero. So for a company like Amul, it might buy a herd of cattle which might reproduce, and after a few years the herd that you have is largely the herd which is the offspring from reproduction, and as a result, after a few years, if you follow the cost model under Ind AS 16, for example, even if you don't follow, initial recognition of a property happens at cost, and the cost of a reproduced asset is, for example, nil. In such a case, your entire asset base will become zero, and hence a separate standard is required for biological assets due to the special features, and hence at initial recognition you will show these biological assets at fair value less cost to sell. In fact, at every subsequent balance sheet as well, these have to be shown at fair value less cost to sell only. So even if there is an increase in the fair value, or if there is a decrease in fair value, it does not really matter. You will show them at fair value less cost to sell, and the difference, if any, will be taken to the profit and loss account. So gain or loss, whether realized or unrealized, will be taken to the P&L. This has to be done at every balance sheet date. It is not necessarily to be done at sufficient intervals. You have to do this at every balance sheet date. Because you are doing this at every balance sheet date, you don't need to depreciate these items as well. So the four important things: initial as well as subsequent recognition at fair value less cost to sell. The unrealized gains or losses, if any, will go to the profit and loss account, and there will be no depreciation. Now, what if the fair value is not determinable? Then the initial as well as the initial recognition will be at cost, and the subsequent measurement will be at cost less depreciation if fair value is not determinable. But you will have to give the reasons on why the fair value is not determinable as well. Next, when you look at newborn assets, at the time of initial recognition, you will show this at fair value less cost to sell. So if a calf is born, your general entry will be calf account debit. Let us say fair value less cost to sell is 10 rupees, calf account debit 10 to gain on initial recognition, which will go to the P&L account, let us say 10 rupees. Now, if disclosure in the notes are required, you will have to show the disclosure between the fair value changes due to price or due to age. So the differences due to price can be calculated, that if the age remains constant, then why is the price different? That the change is due to price, maybe inflation. And then comparing at the same date, that is the reporting date, the prices of two biological assets which are of different ages. So if at the same date the price is different, why is it different? Well, because one is a 3-year cow, one is a 4-year-old cow. Okay, you have to show this if disclosure or extracts are to be prepared. Next is, what if at the stage of initial recognition, your fair value is 100, and that is the same as the transaction price. You are paying 100. However, you have to pay 2 rupees brokerage at the time of buying, that is a cost to purchase, and a 2 rupees brokerage at the time of selling, that is cost to sell. So how will the entry be recorded? Well, you will say cow account debit. 100 minus 2. The minus 2 over here is the cost to sell. That is hypothetically, if you were to buy the cow, pay 100 rupees, and at the time of sale, let us say you will have to pay 2 rupees of brokerage. So 100 minus 2, 98 is what you are going to get. So cow account debit, let us say 98. To bank, to bank, what will you pay? Well, 100 rupees for the cow plus whatever is the cost to purchase. If there is no cost to purchase, that is 200. If the cost to purchase, for example, is 2 rupees, or let us say 1 rupee, so that we keep it different from the cost to sell. So the brokerage at the time of purchase is 1, at the time of sale is 2. In which case you must have paid 101. So to bank 101, in which case a balancing figure will come as 3 rupees. Institute shows this as loss on initial recognition, though you can show this separately as well. So this is regarding biological assets. Second is agricultural produce. Now this is the produce like milk, like the wool on the sheep, or the apples from the apple tree. Now usually they don't have life, and hence they cannot be called as biological assets. However, when you plug this fruit or a harvest, this milk, this will be treated, for example, as inventory. And if it is treated, let us say, as inventory as per Ind AS 2 has to be initially recognized at cost. And if cost over here is just the cost of removal of milk, answer is no. You are managing biological transformation, and because you are managing biological transformation, you might have incurred a lot of cost of feeding, maintaining, breeding these animals. However, you can't put a one-to-one correlation. And because that one-to-one correlation, let us say, is not possible, the standard says, well, you know what? We will deem the initial cost to be the fair value less cost to sell at the point of harvest. Ind AS 2 does not have such special provisions, and hence for the limited purpose of finding the cost initially, the standard allows you to recognize this initially at fair value less cost to sell at the point of harvest. Once you recognize it at the initial recognition, then subsequent measurement will be as per inventory, that is, you will compare the cost or NRV, select whichever is lower, and accordingly you will do the workings for the inventory. The last part is government grants. Now, why do you need a separate standard for, so like we said, biological assets separately because they may reproduce, agricultural produce separate working because when the produce is detached, the true measurement of cost may not necessarily be just the cost that you pay to extract, and hence we show it at fair value as cost to sell at the point of harvest. And lastly, when we look at government grants, when you look at Ind AS 20, it says that if it is a grant linked to an asset, you either deduct it from cost or you defer it in the ratio of depreciation. In this case, there is no depreciation, and hence that method will not work. And second, if you deduct it from cost, you are no longer showing it at fair value less cost to sell, and as a result, it will violate Ind AS 41. And hence, for grants which are given for biological assets which are measured at fair value less cost to sell, the standard says you forget the life of the asset, you treat it as per Ind AS 41 as either an unconditional grant, that is no conditions are attached, in which case the entire amount of grant will be taken to the profit and loss account immediately, or if there are conditions attached, then you will currently take it into the deferred grant and then take it to the P&L as and when the conditions are fulfilled. So if the conditions are fulfilled in one go, let us say at the end of the 5th year, then you will take it to the P&L directly in the 5th year. But if the conditions are fulfilled over 4 years or 5 years, then you will spread it to the P&L over those 4 or 5 years. One needs to remember that if it is a biological asset which is like a bearer plant, or if it is a biological asset which is shown at cost, then you don't need to do these special treatments of Ind AS 41. You can very well apply Ind AS 20. So there's an example also which is given on these regards. So this is by and large the conceptual framework regarding Ind AS 41. What we'll do is we will try to tackle around 3 relevant questions. So over here, if you go to question number, I think question number 1, I wanted to tackle a different question. I think a different question has been included. I'll just probably discuss that separately. Let us go to question number 2 and 3. So first, if you go to question number 2, this is, in my opinion, one of the most important questions of this chapter. So let us review this. Now, Moon Limited prepares financial statements up to 31st March each year. On 1st April 11, it carried out the following transactions. Now, what do you need to do? The question says you need to prepare the extracts from the balance sheet and the statement of P&L that would be reflected in the financial statements for the year ended 31st March 2012. So over here, when you look at that perspective, you need to prepare the extract of the financial statements. Purchase land for 50 lakhs. Achha, this is purchase, let us say 1st April 11, you need to prepare the balance sheet on 31st March 12. But land is something which will be recorded as per Ind AS 16, that is PP, and if nothing is given, you will record it using the cost model. Land does not get depreciated, so in the balance sheet within PP, you will show the land at 50 lakhs. Okay. Second, purchase 200 dairy cows. Dairy cows is for the purpose of milking those cows. Dairy cows with an average age of on 1st April 11 of 2 years at 10 lakhs. So 10 lakhs divided by 200, that is coming to approximately 5,000 per cow will be the initial recognition. So this is purchased on 1st April 11. This will be covered by Ind AS 41. At every balance sheet, subsequent balance sheet date, you will measure them at fair value less cost to sell. There will be no depreciation. Received a grant of 1 million, that is 10 lakhs towards the acquisition of cows. This is a grant towards the acquisition of cows and hence will be covered by Ind AS 41. The grant was non-refundable. If it is non-refundable, it is unconditional and hence it will be taken to the P&L immediately. So when you prepare the extract, 10 lakhs will be shown as grant income directly in the P&L. For the year ended 31st March 12, the company has incurred the following cost: 6 lakhs to maintain the condition of the animals. This 6 lakhs will be taken to the profit and loss account. Secondly, 4 lakhs is breeding fee to the local farmer. Again, this will be taken to the profit and loss account. On 1st October 11, 100 cows were born. So initial recognition will be calf account debit to gain on initial recognition. And there were no other changes in number of animals during the year. As at 31st March 12, Moon had 3000 liters of unsold milk in inventory. Now this is agriculture produce, this is harvested. The milk was sold shortly after the year end at market prices. So you have been given the fair value cost to sell of land 50, 60 and 70. Now if you assume that the land is recorded using the cost model, it will be recorded at 50 only. No further changes in the PP. If you assume that this is recorded using the revaluation model, then the land will be shown at 70 and 20 rupees will be shown as a revaluation reserve as a part of other comprehensive income. We will institute as assumed cost, we will also assume cost. Then you have the newborn calf. Now these calves, if you go to see, were born on 1st October and you will initially recognize them at 1100 rupees. So on 1st October, your entry will be calf account debit 100 into 1100, that is 1,10,000 to gain on initial recognition in the P&L account 1,10,000. So your calf in the balance sheet on 1st October will be 1,10,000 and a corresponding 1,10,000 will be taken to the P&L. Now by the end of the year, this calf will be a 6-month-old calf and 6-month-old calf is now worth 1,300. So there is a fair value gain, for example, of 200 rupees. Now this 200 rupees will increase the value per calf. So 200 rupees into 100, that is 20,000 will be the increase in the fair value and hence the calf will be shown at 1,10,000 plus 20,000, that is equal to 1,30,000. However, double entry, that is calf account debit 20 to what will gain on remeasurement or fair value gain of 20,000. Now one needs to remember that whenever extracts or disclosures are to be given, wherever possible we will show the difference between the difference due to price as well as difference due to physical that is change age. So the difference between 1100 and 1200, that is equal to 100, is due to price, and the difference between 1200 and 1300, that is again 100, is due to age, physical change. At the same date 31st March, the price is different and hence 100 into 100, that is 10,000, is the difference due to price, 10,000 is the difference due to age. So if you look at your extract of the balance sheet, you will have PP at 50 lakhs. Then you will have calves which you have earlier shown at 1,10,000 plus 20, so this comes to 1,30,000. Second effect, in your profit and loss, you will have unconditional grant which is 10 lakhs, fair value gain on the birth of the cows 1,10,000, 10 and 10, fair value gain of 20,000. Now you go to the dairy cows. The dairy cows you purchased at 5,000. By the end of the year, the price became 5,500. Achha, you purchased a cow which was 2 years. By the end of the year, it is now a 3-year cow and hence the price becomes 5,500. So there is actually an increase, if I go to see over here, of 500 rupees. Now this increase of 500 will be taken to the profit and loss account. So your cows will initially be recorded at 10 lakhs at the start of the year, and then there is an increase of 500 into 200, that is equal to I think 1 lakh rupees. So over here, this is 10 lakhs plus 1 lakh, this is equal to 11 lakhs. This is shown as a separate line item within the biological assets. Now the second effect of this will go to the P&L. Again, when you take it to the P&L, you will take the difference due to price. So if the cows were hypothetically of the same age, the price is going up by 200 between 5,000 and 5,200, and between these two, the price is going up by 300 on the same date. A 3-year-old cow is 5,500, a 2-year-old cow is 5,200, and hence the difference of 300 is due to age. So over here, that is 200 into 200, 40,000 is the difference due to price, 60,000 is the difference due to age, and hence 1 lakh to be taken over here. Now when you look at milk, we can assume that the milk must be harvested somewhere at the end of the year when the price is 24, and hence 24 into let us say, how much is this? 3,000 liters. 24 into 3,000 liters, that will come to around 72,000. So that will be your milk. You will debit the milk and credit, let us say, gain on the initial recognition of milk of 72,000. You can also show this as changes in inventory, though the institute over here actually shows this as fair value gain, and hence we do the same. So in the balance sheet, if you go to see within current assets, you will show inventories, and that inventory of milk is at 72,000, and corresponding to that in the other income, you will show milk at 72,000. Apart from that, there were other expenses like 6 lakhs and 4 lakhs, totaling up to 10 lakhs, and hence that will give you your amount in the profit and loss, and then a separate disclosure and an amount being shown, let us say, into the balance sheet. So that takes care of the question number 2. Next you go to question number 3. This is a fairly tricky and an interesting question. So let us review question number 3. X purchased 100 beef cattle. So that is very important. Beef cattle, remember, is cattle which is purchased for the purpose of slaughtering and selling, or for the purpose of selling in the ordinary course of business. If you compare that with the earlier question, over here you had purchased dairy cows. Remember, dairy cows are purchased not for the purpose of purchasing and selling or slaughtering. They are purchased for the purpose of using them for the purpose of milk that they give. Whereas beef cow or beef cattle, for that matter, is slightly different. So this small thing might create a difference in presentation. At least how the institute has solved it. For an auction for rupees 1 lakh on 30th September 2011, subsequent transportation cost were 1000, and that is similar to the cost that X will have to incur to sell the cattle at the auction. So 1000 is the cost to bring the cattle from the market to your, let us say, shop or your warehouse or whatever that place is, your site, and then another 1000 will be the cost if you have to sell this cattle at a future date to get it back to the market. So there are two different 1000s. One is a cost to purchase, one is a cost to sell. Additionally, there would be a 2% selling fee on the market price of the cattle to be incurred by the seller. Now remember, this can be incurred by the buyer, it can be incurred by the seller, or it can be incurred by both of them. In this case, this 2% selling fee is to be incurred by the seller only. So this is on the sale price. So if I do 1 lakh into 2%, that will be 2%. It is like auctioneer's charges. This will be paid by the seller. So when I purchase, the seller must have paid it. That has no connection with me. However, when I have to measure a biological asset, even if it is beef cattle which is held for the purpose of sale, it is still, till the time there is life, it is a biological asset to be covered under Ind AS 41. So over here, you will measure it at fair value less cost to sell. So this is the data which is regarding 30th September 2011. If you have gone through the question, there is a lot of data given pertaining to various dates. Before we kind of proceed further, if I just see what is asked in the question, you are asked to pass the journal entries to provide the initial as well as subsequent measurement for all the above transactions. Okay. Interim reporting periods are 30th September and 31st March, and the company determines the fair value on these dates. So technically, you can keep on remeasuring and find the fair value at each of the intermediate dates. However, the reporting periods are 30th September as well as 31st March, and hence fair valuation for the purpose of reporting will be done, let us say, on these two dates, and you are asked to pass the journal entries. So if I go to the situation on 30th September, you are purchasing the beef cattle, and what is the value? Well, 1 lakh is the fair value minus cost to sell. Now 2000 is to be incurred by the seller. So hypothetically, if I were to sell the cattle immediately, I will have to pay another if I were to sell the cattle immediately, then I will have to pay another, let us say, 2 lakh rupees for the purpose of selling this 2000 rupees for the purpose of selling this cattle. So I will subtract this 2000 over here. Additionally, cost to transport. Now remember, there is a cost to bring the cattle to your warehouse and a cost to take it back to the market. So when I incur the cost to take it back to the market, that is another 1000 rupees, and hence this comes to 97. So your initial recognition for the beef cattle should be at 97,000. Will you also pay 97,000 for it? Well, at the time of purchase, you will have to pay for 1 lakh rupees. So that is incurred to buy this cattle. 2% commission you will not need to pay now, and another 1000 rupees to get the cattle to your farm, for example, and as a result you will pay a total of 1 lakh plus 1000. Sir, but you have already taken 1000, that is a separate 1000 to take it back from the farm to, let us say, the market, and as a result what you will be paying, for example, is 1 lakh 1000. So if you were to pass the journal entry over here, let us say on 30th September, your journal entry 11 would be, let's say, beef cattle account debit. This will be debited by 97,000 to bank. Your total payment that you will make will be 1,01,000, and hence the remaining 4,000 balancing figure will be shown as a loss on initial recognition that will be taken to the profit and loss account. So a fairly important and interesting adjustment is, so this is on 30th September. Next you go to 31st March 12. So half yearly you are doing the reporting. So on 31st March 12, the market value of the cattle in the most relevant market increases to 1,10,000. So that is, let us say, the fair value increasing to 1,10,000. The transportation cost of 1,000 will still have to be incurred by the seller to get the cattle to the relevant market. This is the cost to get it from the farm to the market, and an auctioneer's fee of 2% on the market price of the cattle would still be payable by the seller. So basically now the fair value less cost to sell will be 1,10,000 minus 2%, that is 2,200 minus 1,000, and as a result this will come to 1,06,800. Now over here we will have the initial recognition at 97,000, and this will now come to 1,07,800, and hence there is an increase of around 9,800. So what will be the entry over here? It will be cattle account debit to, let us say, fair value gain or gain on remeasurement, and that will be taken to the P&L. So if you go to see, this is the first entry of 97,000 and then 9,800. Things hopefully should be going smooth till now. Next, on 1st June 2012, now this is where you encounter some level of turbulence. So on 1st June 12, X sold cattle for 20,000 and incurred transportation charges of 150. In addition, there was a 2% auctioneer's fee on the market price of the cattle paid by the seller. Now there are a couple of things. First, what is happening? You are selling the cattle. So if you were to sell this cattle, then let us say if I were to pass the entry on 1st June 2012, then ideally from what we have studied till now, we will say bank account debit with what the money is we are going to receive. So we are going to say we are selling this for 20,000. We are still going to pay the 2% auctioneer's fee, so that is 400 rupees, and another 150 rupees to transport the cattle to the market, and as a result you will get, I think, 19,450. So over here this will be the money that you get to cattle. Now at what value will the cattle be shown in your books? The last remeasurement happened, and we are told to remeasure at every half yearly date. So the last remeasurement happened on 31st March when the value of the cattle was 1,06,800 for 100 cattle, and hence one cow in that cattle was worth 1068. 1,06,800 divided by 100. So now I'm going to derecognize 100 में से I'm going to derecognize 18 of them. So this is, let us say, 1068 into 18, and you will be getting the cattle which is to be derecognized. So if you show this working, probably this is going to be 19,224 if you calculate. So this is 19,224 you derecognize, and hence there will be a gain on sale or derecognition as a case may be, which will be taken to the P&L at around 226, and that should be it. So ideally things should have ended over here and we could have proceeded further. So this is one alternative. In fact, we thought this is the only alternative. Now another possible alternative which will give you the same answer, I mean you can do that, is alternative 2. You will remeasure the cattle. You will say that first, before derecognizing the cattle, I mean, yes, we are told to remeasure on 30th September, but we can also remeasure earlier. So if you were to remeasure, you will say, okay, cattle account debit. So this will be debited by 226. That is nothing but 19,450, which is what we are going to get, as opposed to 19,224 at which it is appearing, to, let us say, the gain on remeasurement, which will again be taken to the P&L account. So this is 226. Now secondly, when you will sell this cattle, bank account will be debited by 19,450, and you will credit the cattle which in your books has, now this cattle has come to 19,450. Now this is alternative 2. Either of these alternatives will work, provided the cattle was held for the purpose of use in the ordinary course of business. So this would have been working if this was what we would say is a dairy cow. So see, remember, whether it's a dairy cow or if it's a beef cattle, at the end of the day, it is a biological asset, and hence Ind AS 41 will apply, and hence we will show it within the larger heading of biological assets other than bearer plants. However, good accounting practices tell you that how should you show the transactions for these items. Like when you sell a fixed asset, let us say general fixed asset like furniture, land, building, etc. How do you recognize the entry? Well, we just recognize a gain on sale. So if a fixed asset of 100 rupees is sold for 120, we will say bank account debit 120 to fixed asset, let us say 100, to, let us say, the gain on sale of 20 rupees. So we will directly recognize a gain on sale, for example, of 20 rupees. However, if this same item was an inventory, I will not recognize the sale. I will not recognize a gain on sale. I will recognize the entire sales of 120. Then I will have COGS, like opening stock, purchases, where that 100 would have been purchased, and if there were any other expenses, then for each of these expenses I will show a line by line different items. So when I look at inventory, I'm selling this in the ordinary course of business, and if I'm selling this in the ordinary course of business, I will show the revenue and the cost and the individual line items on expenses separately, so that a proper presentation is given. However, I do not sell the fixed assets in the ordinary course of business, and as a result I will just directly show the gain on sale for the fixed assets. Now, keeping that into consideration, when a dairy cow is sold, a dairy cow is not something that you are selling in the ordinary course of business, and hence you can directly book the gain on sale and show it to the profit and loss account. However, a beef cattle, when a beef cattle is sold, you are holding it for the purpose of selling or slaughtering in the ordinary course of business, and as a result, rather than showing just the gain on sale, it is more appropriate if you show the sale and also show the cost of goods sold separately. And that is what the ICA has done. A lot of students are confused that why is it done separately. It is because the question had given you that this is like a beef cattle. If it was a dairy cow, probably this treatment may not have been done. So if I look at alternative 3 over here, alternative 3 would say that you will first book the sale. So your entry would be bank account debit. So we will say 20,000 rupees and I will get on selling. So 2 sales. So this is 20,000, and this 20,000 worth of sales will go to the P&L. Further, the cattle, I mean, you can either remeasure the cattle, get it up to 19,450 and then record, or you can directly show the cattle at 19,224 as well. That's absolutely fine. You will say COGS, cost of goods sold. Like, this cattle must be there in opening stock. So when you look at opening stock in your trading and P&L account, your opening stock, you have P&L account debit to the opening stock. So this is your cattle. So over here, so COGS, which will go to the P&L. So this will be, for example, 19,224 to, let us say, the cattle. In your ledger, if you have not remeasured it, this will come to 19,224. Apart from that, there are a few other expenses like transportation cost, which will go to the P&L, like auctioneer fee, separate line item, for example, which will go to the P&L, which is, let us say, transportation cost of 150, auctioneer fee of, for example, 400, and hence there will be a 2 bank payment of, let us say, 550. So if I go to see now, from your perspective, there will be sales, that is a revenue, which will be booked at 20,000. Then there will be cattle that will be transferred as a part of the COGS. This is at 19,224. Then there will be transportation cost, which will be, let us say, 150, and auctioneer fee, which will be coming at 400, and hence there will be a balancing figure, which is, by the way, 226, which is the same. However, this is something that you will do provided this biological asset is in the nature of inventory. Remember, you will not show it as inventory, nor will you show a dairy cow as PP. You will still show everything as a biological asset other than bearer plant, but the presentation would be done in such a way so that it can give a better picture. So this is what you will do if, for example, this is beef cattle which is held for the purpose of sale or slaughter in the ordinary course of business. Now an alternative 4 technically over here is also possible, where all else remaining constant. So in alternative 4, your entry number 1 remains the same, your entry number 3 remains the same. However, you will also, so 1 and 3, the entries remain the same. However, instead of entry number 2, you will first remeasure. So you will say cattle account debit, let us say 226, to gain on remeasurement, which will go to the P&L at 226, and then in the COGS, so you will have COGS account debit, let us say 19,450 now to, let us say, the cattle. So ultimate effect, if you go to see, will remain the same. Here also that 226 will go to the P&L. What has the ICI done? Well, ICI has done alternative 4, where it has shown the revenue separately, shown the auctioneer's fee and transportation costs separately, remeasured the cattle, and then taken it in the COGS. In my opinion, that remeasurement is not required, specifically because on 15 September a similar event will happen. They don't remeasure, and the question very categorically tells us that you don't really need to remeasure at every date. The company will remeasure at the interim dates, and hence in my opinion alternative 3 would have been the best alternative, but nevertheless the ultimate effect remains the same. So this is one particular point where students do have a problem. I hope you have had some level of clarity over here. Now if you proceed further, you go to now 15 September, another problematic date. So earlier you had 100 cattle, out of which 18 are sold, and hence you are now left with 82 cattle. Now on 15 September 2012, the fair value of the remaining cattle must be how much? 82, was 82,820. Remember, In your ledger, this 82 cattle at the carrying value is still 1068. You are not remeasuring it every date. You are remeasuring on 31st March and then on 30th September. So the remaining cattle of 82, each cattle is still worth 1068. That is 1,06,800 divided by 100. The 42 cattle out of 82, 42 cattle were slaughtered on that date. Okay, so हमको थोड़ा दुख हुआ. But let us say those 42 cattle were slaughtered on that date with a total slaughter cost of around 4,200 rupees. Okay, so there is a cost to slaughter. The total, so is that cost already incurred or is it yet to be incurred? So that has already been incurred. So now there was a live biological asset, you have slaughtered it and now it is no longer a live biological asset, and it now there is cessation of life process, and hence the biological activities end. So this can be called as harvest. Now at the point of harvest, this is like an agricultural produce. Agricultural produce, your biological asset is slaughtered, life processes end. So at the point of harvest, you will measure the produce. Produce is the carcass. Remember, the biological asset, the live asset was the cow. You slaughter it, you incur certain cost, and it's like the dead cattle, and the dead cattle is called as a carcass. That becomes your inventory, which you are going to sell in the ordinary course of business. Now I will not show this as a biological asset because the life processes have ended. However, the inventory at the point of harvest is shown at the point of harvest is shown at the fair value less cost to sell of that item. So that item, for example, is the carcass. So over here, the total market price of the carcass is on that date was 48,300, and the expected cost to transport or the cost to sell the carcass is 420. No other costs are expected. So on 15 September, what is happening is you are now having carcasses, which is now an inventory, no longer a biological asset. But then you will have to derecognize the cattle. You will derecognize the cattle to the extent it is there in your book. So over here, you will take the inventory, and this is inventory comprises of carcasses, which is like your agricultural produce at the point of harvest, which you will recognize at the fair value. The fair value is not the fair value of the cow, it is the fair value now of the carcass, which is 48,300 minus the cost to transport, which is 420 rupees. So you will deduct the 420 rupees over here. Sir, but there is also slaughter cost. Now that is not the cost to sell. Remember, cost to sell are the incremental costs that are yet to be incurred. 4,200 is an actual cost that you have incurred, because of which the biological asset now is an agricultural produce. And as a result, that is not still an incremental cost to be incurred. 420 is yet to be incurred. 4,200 is already incurred. So how will you account for that? We'll just see this. So this is 48,300 minus 420. So this is 47,880, I think. 47,880. So this is inventory debited. Now what are you going to credit? Sir, we are going to credit the cattle. How much cattle? Well, 42 are slaughtered, and each cattle in your books is worth 1068. And as a result, you will credit this cattle by 44,856. So you will credit 44,856. This is derecognized and inventory is recognized. Now there are two ways in which you can solve, and both of them will give you the same answer. So over here you can say, well, that means there is a gain on initial recognition, and the gain on initial recognition can be taken to the profit and loss account. So if you find the balancing figure over here, 47,880 minus 44,000, just a second. So if I just calculate this, 47,880 minus 44,856, it comes to around 3024. So this is 3024, and there will be separately a slaughtering cost. So you can say slaughter cost or anything else. Slaughter cost, which you will incur. Where will this go? Well, to the P&L. Sir, can I capitalize it along with the inventory? No. Inventory initially is to be recorded at fair value as cost to sell. You have already recorded at fair value as cost to sell. You cannot separately adjust anything over here. So this is 4,200, which will go to the P&L to, let us say, bank. 4,200. So in my opinion, this is the best way to present. However, the institute has done a little bit of shortcut over here. They've said that rather than showing a gain which is going in the P&L of 3024, then showing a slaughter cost of 4,200 which is debited to the P&L. So basically in your P&L, there's a 3024 gain and a 4,200 cost. So if I take the difference between the two, that is approximately a 1176 rupees net debit on the P&L. So alternatively, what the institute has done over here, and ultimately the effect remains the same, is it has debited the inventory correctly by 47,880. It has also credited the cattle correctly by 44,856, But then rather than passing a separate entry for slaughtering, they've just recorded the slaughtering of 4,200 over here, and hence the balancing figure directly shows you as the loss on initial recognition, and this loss on initial recognition will go to the profit and loss account. Now this is directly the 1176 which I was referring to. If you want to solve it by giving two different effects, in my opinion that is a better presentation, that would also work. But otherwise, if you pass it as a single combined entry, that is also very well acceptable, where you show the loss on initial recognition coming at 1176. This is what the institute has done. So we are trying to explain the alternative treatments as well as what the institute has done. So now we are almost at the fag end of the question. We now finally come to 30th September 2012. Earlier you were on 15th September. You have been given the fair value, but the question is very clearly given you that you are remeasuring only at 31st March and 30th September, and hence in line with the institute solution, we have not done any remeasurement on 15th September. We will directly do this on 30th September. So on 30th September 12, the market price of the remaining 40 cattle was 44,800. Okay, so this is for the remaining 40 cattle, that is after 42 and 18. The expected transportation cost is 400. Also there will be a 2% auctioneer's fee on the market price of the cattle payable by the seller. So basically 44,800 and a 2% auctioneer fee. So this is basically 44,800 into, let's say, 2%. So that comes to, I think, 896 if I'm not wrong, and 400 of transportation cost. So 44,800 and less 400, I think this comes to around 43,504. Now this is a fair value less cost to sell of the biological assets, which are still going to appear as a part of your biological assets. In your books of accounts, this cattle currently is appearing at 1068 into 40, the remaining 1068 into 40, and this cattle is still appearing at, I think, 42,720, and hence if I take the difference between the two, 43,504, and the difference, it is 784 of gain, and hence if I go to see, your entry will be cattle account debit to gain on remeasurement. This is 784, which will go to the profit and loss account, the last entry. So this is something which is fairly tricky as well as interesting. I hope this is clear. Now apart from that, the first question I said we had kind of left that. The first question is more of a theory based question on identification whether a particular activity is an agricultural activity or not. I don't see a full-fledged question coming on this in the exam. However, for an MCQ perspective, maybe identification of an activity as agriculture or not is important. While you are doing that, remember you have to look at three levels. First, you look at whether it is a biological asset, that is, does it have life other than bearer plant. So it has to be other than bearer. If it is bearer, it is covered under Ind AS 16. Second, you look at the fact that whether it is an agricultural activity. For you to show it as an agricultural activity, the biological asset should either be held for sale, or it has to be held for converting into agricultural produce, or it has to be held primarily for the purpose of having additional biological assets. And third, you should be managing biological transformation. So you should be someone who is managing biological transformation. So if all the three conditions are satisfied, only then will you be covering a particular item under Ind AS 41. So analyze whether the following activities fall within the scope of Ind AS 41 with proper reasoning. First, managing animal related recreational activities like a zoo. So in case of a zoo, you are managing the biological assets, their transformation, their living assets other than bearer plants. However, they are not held for the purpose of sale or for converting into agricultural produce or for additional biological assets, and hence over here this is not covered under Ind AS 41. Instead, probably we look at something like Ind AS 16 here. Fishing in the ocean fishing, there may be a living asset like a fish. Maybe you're holding it for sale, but you're not managing the biological transformation over here, you're directly harvesting, and hence this will not be covered under Ind AS 41. Probably this will directly go under Ind AS 2 as inventory when you fish it. Next, you look at fish farming. In case of fish farming, you are maintaining probably an artificial pond for the purpose of fishing. So there is a living asset fish which you are holding it for the purpose of either sale or for breeding, that is additional biological asset, or for fishing it out, that is agricultural produce. So definitely you are doing an agricultural activity and you are also managing the biological transformation. So yes, for fish farming, Ind AS 41 will finally apply. Now when you look at development of living organisms such as cells or bacteria or viruses, the answer over here given by the institute also is a conditional answer. That is, there may be these cells or bacteria which are used for the purpose of research or development. So if you are using them for the purpose of R&D, then you're not, I mean, they may be biological asset, you may be managing the transformation, but you're not holding them from sale or for converting into additional biological assets or for the purpose of, let us say, agriculture produce, you're holding them for R&D purpose, and hence this will not be covered under Ind AS 41. However, it might be expensed to the P&L account, because usually the cells, bacteria, etc. will not have a life of more than 12 months, and hence you will expense it to the P&L account in general. However, if these are held for the purpose of sale, like for example you have yeast. Now yeast is something which is a living item which is used for the purpose of making bread, and you are making yeast for the purpose of sale, and hence in such a case, if yeast is made for the purpose of sale, then this will be considered as an agricultural activity. Now, growing of plants to be used for the production of drugs. Now, maybe drugs like opium, etc. can be made from the leaves or flowers of particular specified plants. So you are growing these plants which bear the leaves or the flower from which you can manufacture drugs. Now ideally these would be bearer plants because they bear agriculture produce, and they are not agriculture produce themselves. Like food grains, wheat grains are usually bearer plants. However, these plants usually don't have a life of beyond 12 months. For you to be a bearer plant, the life should be beyond 12 months. So if the life is not beyond 12 months, like an annual crop, then this is not treated as a bearer plant. So the same analogy is drawn over here. You are having a living asset that is like a plant, where you are holding these plants for the agricultural produce, that is probably the leaves or the flowers, and you are managing the biological transformation. However, if the life of this plant is beyond 12 months, it becomes a bearer plant, goes under Ind AS 16. But if it is less than 12 months, then it falls under Ind AS 41. This is for the purpose of agricultural produce, and hence Institute over here has covered this under Ind AS 41. My opinion over here is, if the life is assumed to be beyond 12 months, then if it is a bearer plant, then it can also go to Ind AS 16. We are not experts in drug making, hopefully, or not, let us say, the ingredients, so we can give a conditional answer, though Institute's answer over here is Ind AS 41. Acha, purchased from 25 dogs for security purpose for the company's premises. Again, these dogs are living assets. You are managing the biological transformation, but again not held for sale or for agriculture produce or for primarily additional biological assets, and as a result this will not be covered under Ind AS 16. However, Ind AS 41, instead you can take it under Ind AS 16. So maybe in an MCQ, if it comes, you should be able to address. I hope this video has been helpful to you. If you like it, please do like, share and subscribe, and also comment on whether this video has been helpful to you. I'll see you soon with another video. Till then, study well, study hard, and bye bye. Take care.